Hello to all mentors inside our group chat. I apologize with the delayed weekly overview. I thought you could have other sources aside me. The Federal Reserve maintained interest rates, and Jerome Powell decisively dismissed any speculation of a cut in March. However, Fed Fund futures suggest the possibility of 4 consecutive 25 basis points cuts starting in May. Despite a significant decline in inflation, Powell played down the notion of imminent rate cuts, stating that the Fed remains cautiously optimistic and hasn't declared victory yet. He highlighted robust economic growth, resilient consumer spending, and a tight labor market as factors that may sustain inflation above 2% for an extended period. A pre-recorded interview with Jerome Powell, conducted after the latest FOMC decision, is scheduled to be broadcast on Sunday at 1900, as announced by 60 Minutes. Australia's headline CPI figures fell below expectations, leading RBA cash rate futures to fully anticipate a 25 basis points cut in June. The International Monetary Fund (IMF) upgraded its growth outlook for 2025 and observed that inflation was softening more rapidly than anticipated. In contrast, the ISM Manufacturing Index contracted at its slowest pace in 15 months, while new orders and prices paid expanded. USA. Jerome Powell's upcoming interview with 60 Minutes, following the Federal Reserve's resistance to a March rate cut, raises intriguing questions. Will Powell align with dovish market expectations, or is it another opportunity to challenge current sentiments? Reflecting on Powell's April 2021 interview, where he emphasized caution in rate hikes, it became clear that the Fed's pace wouldn't match market hopes. Traders adjusted their outlook, reducing the probability of a March rate cut to 35%, strengthening the US dollar temporarily. However, the dollar's gains proved short-lived due to persistent expectations of multiple rate cuts this year. The decline in U.S. bond yields, influenced by reduced government borrowing and concerns about regional banks, further impacted the dollar's struggle to rally. While ISM Manufacturing suggests a sector trough, the ISM Services nearing contraction raises potential concerns. If coupled with sluggish, new orders, and prices paid, it might weaken the dollar on expectations of rate cuts in May. However, a rapid contraction leading to recession fears could alter the market's perception, potentially viewing bad news as genuinely negative. The upcoming ISM Services data in January holds significance as a crucial leading indicator for the U.S. economy. Positive results might prompt a re-evaluation of rate cut expectations, bolstering the dollar's momentum. EU. EUR/USD retreated from a 6-session high on Friday due to a sharp dollar rally triggered by the surprising upside in U.S. January payrolls. However, the pair's broader range might endure as investor expectations for the Fed and ECB converge. The robust January non-farm payrolls and average hourly earnings, surpassing estimates, suggest a resilient labor market and potential wage inflation. This data aligns with the Fed's rate cut outlook, prompting investors to revise expectations, reducing the probability of a March cut to 20%. With investors now anticipating similar total basis point cuts for the Fed and ECB in 2024, around -125 bits per second each, the dollar maintains a yield advantage over the euro. This convergence in rate cut paths could limit significant moves in EUR/USD throughout 2024. Since January 2023, EUR/USD has traded within the 1.0500–1.1100 range, consolidating gains from the 2022 low rally. This range may persist, especially if the Fed and ECB continue cutting rates by nearly equal amounts, unless significant softening occurs in U.S. economic conditions. Influencing the Fed's rate cut outlook. UK. Sterling faced a notable decline after Friday's robust NFP and wage data, driven by a significant rise in U.S. yields and reduced odds of a March Fed rate cut, currently standing at less than 20%. Despite pre-payroll gains, the pound slipped from 1.2770 to a new low at 1.2647, anchored near recent lows. The narrowing US-UK yield expectations make it unlikely for traders to challenge the 2024 high at 1.2788 in the near term. Sterling is likely to remain capped by 1.2825, the December 28 trend high, as Friday's data reinforces Fed Chair Jerome Powell's views on persistent U.S. inflation. Traders will now turn to the February 13 to 14 US and UK CPI data for insights into inflation trends, influencing when the Fed and BOE may consider lower rates. In the absence of significant data, GBP USD is expected to stay within its 2024 range of 1.2825–1.2597 aus. As the Reserve Bank of Australia (RBA) convenes, the spotlight shifts to whether it will abandon its tightening bias. Market expectations lean towards unchanged interest rates, prompting attention on the RBA's stance on further increases. Recent data, including a slowdown in Q4 inflation, job losses, and underwhelming holiday season spending, challenges the possibility of additional rate hikes. The weakening domestic economy, coupled with China's struggles in its property market, diminishes the likelihood of a rate increase. Governor Michelle Bullock's initial communication challenges raise concerns about potential confusion in the RBA's policy messaging. While a rate cut on Tuesday appears improbable, any acknowledgement of softer inflation in statements or press conferences could signal ongoing discussions about future cuts. Despite quarterly retail trade figures preceding the RBA's announcement, significant deviations are needed to impact their decision. Even if the RBA maintains a tightening bias, the Australian dollar's overall outlook remains gloomy. A sustained rally hinges on substantial recoveries in China and commodity prices. Canada, New Zealand and China. In the realm of commodity currencies, New Zealand and Canada take the spotlight with upcoming employment data. New Zealand's Q4 forecasts anticipate a looser labor market, with a potential rise in the unemployment rate to 4.3%. This could lead to a negative reaction in the New Zealand dollar, signaling a case for potential interest rate cuts. Canada kicks off with the Bank of Canada meeting deliberation summary on Wednesday, offering insights into discussed matters. On Friday, the employment report for January will shed light on whether the rising unemployment trend persists. China's inflation stats on Thursday forecast a deeper dive into deflation for January. This could revive concerns about the future outlook, impacting local stock markets and keeping the China-linked Australian dollar on the defensive.